for the founders here, Flavia is going to talk about the funding pathway. So she will explore the different options that are available from a sort of kind of startup access to finance point of view, from equity investment to loans and so on. And she has over 8 years experience of working in the investment community as well. So Flavia, over to you for the next at least 1 hour for sure.
Fabulous. Thank you so much, Julia, and thank you for the invitation. It's such a pleasure to be involved in our ecosystem and to be able to deliver this with so many great companies today. I know it's early morning, so I will try to make it fun. Who am I? I have been working for about close to 8 years before joining SVB in venture capital. I was a portfolio manager for London Co-Investment Fund. So working with over 140 companies by the time I've made the transition. Luckily, I'm still in the ecosystem with dealing with companies from seed to Series A and B throughout the I would say, the most challenging period of your journey. And I have collated in my presentation all those bits of information that I think are so vital for your journey. And every single day companies ask me these things, so I've tried to answer them with data, to remove some of the mythology that is in our ecosystem and to set you up on the right pathway. What is the agenda? I'm going to quickly whiz through what SVB does and how we support companies. Then I'm going to go into a market update. I feel that is very important for you to understand the ecosystem and its dynamics. 2020 is a challenging year. A lot of things are changing, and you're reading a lot about our ecosystem in various different magazines and online. I think it's very important for you to just understand where we are right now, because if you do, then I feel you're going to be a lot better equipped to go out there and understand your funding journey and be able to answer questions that are very important to you. And nicely after that, after we evaluate what you're actually funding and what are the sources of capital that you can use, we're going to look at a little bit around the investment appraisal process. And this gives you a foundation on what's going to happen in the rest of the day. So I've been very mindful that we'll have 3 investment experts coming after me, and I wanted you to just see the bigger picture, because then you're able to dive into all of those finer details after the event. And finally, I'm going to close off with looking at the financing. As you're rushing into Series A and B, things happen very quickly, and I think it's very, very good at the onset to be able to take a step back and appreciate the journey ahead and all the ways in which you can capitalize the company after that point. And last point will be just to show you a few very active investors in our ecosystem and to let you have them in your strategy, because these organizations are doing an amazing job in our ecosystem, and I think it's very important for you to just be aware of who they are. So I'm going to start with very, very quickly with Silicon Valley Bank. We service the innovation economy. We work with the innovation across the whole spectrum and life cycle, from early stage, where I sit, all the way to IPO with our Leering investment bank. And we are very fortunate to have close to 40 years of experience banking and providing very specialized products for VCs and private equity funds. And the way we do this is by being central to the ecosystem, leveraging the insight from our corporate partners and management and angel investors and communities. And clearly, every single one of us has a very important role to play in a number of accelerators in all the markets where we operate. We have been expanding quite quickly, and hopefully Europe is going to be our next frontier. We have a presence in Ireland, in Denmark, and in Germany, and hopefully in the next few years we're going to be able to service a larger part of Europe. We support our clients along the life cycle, and many of the companies here on this slide you would have seen, you would have heard of, maybe even work with. Many of them have joined us when they were just starting, doing their seed rounds or family and friends rounds, and they have been with us for the longer journey, and we've been able to service them with different products, from very core support that we offer in early stage to venture loans and working capital lines and interesting things as they're approaching the exit. When it comes to benefits, we're very fortunate to have done business with some of the largest technology companies in our ecosystems around the world, and we're very, privileged to pass on some of the great benefits to every single one of our clients. So if you are ever considering a partner, definitely SVB should definitely be on your list. Now moving to our workshop, I think it's very important to look at the market and how it's actually changed. There are a few things that you have to look at the onset. We sitting in the UK are very privileged. We have close to about 800 funds that are active across the whole life cycle of a company. And in 2020, the first half, we had 4.7 billion invested. Yes, we're a little bit behind 2019, but we've been dealing with a unique set of circumstances. Saying that, we're still doing quite well, and I'm going to show you in a second for seed and Series A how this plays out in final details. In terms of startups and investors, one thing that is the theme of the year and has shaped the discussions with companies and investors has been the growth targets. It's clear that a certain type of company and a certain strategy works particularly well in lockdown, and it's defining the next pathway as well. So if you're going into fundraising this year, it's very clear to understand how do you define your commercial strategy and to have a very robust plan for growth. It's clear that the more ambitious and the more quicker you move into doubling down on getting market share, the better. So you have to be able to compete in a very changing ecosystem. As a consequence, this means that companies both at seed and at Series A are slightly more mature. When I started in this, in this industry, it was a seed round was a company that was still very much developing the product. As you will see very shortly, this has changed quite dramatically. And the final point, and this is purely for your planning and logistics, it takes a little bit longer for you to fundraise. We're all moving into a digital mode, and we're dealing with our clients in a way in which it enables us to make that, to be absolutely confident. It just takes a little bit longer. So if you were planning 3 to 6 months last year, this year you have to be very mindful that all the interactions that have to happen before an investment decision is made, it will take a lot longer, just due to the fact that we are not able yet to have that one-to-one. Moving into the dynamic and what actually happens when we say that we have higher hurdles. This particular slide that I will draw your attention to, in particular the seed round and the Series A, it means that the expectation for revenue is something that we haven't seen before, and for seed is something that is increasing quite substantially. So we're going into this year expecting companies at seed to have at least that £500,000, maybe $750,000 of revenue. This is something that clearly has an impact. It means that as a company in the ecosystem, you have to be aware of these higher benchmarks, and you have to allow yourself a lot more time and to put commercial validation first ahead of everything else. You clearly, if you are pre-Series A, you clearly have a very solid understanding of the million pound, 1.5 million of $1 million of revenue, which is expected. In some cases, a little bit more. That has not changed. Maybe later on, the growth and the level of revenues that you have to achieve have increased. But for Series A, there's some sort of constant. I can see a couple of questions, and I'm going to try to take them as we go. Okay, so the question is around working capital and revenue. So this is not about working capital. This is purely around the ability to generate revenue. I would say that it is clear from the onset that you absolutely have to have at least a bit of traction to be able to go into seed, the way seed is defined in our market. So I'm not looking very broadly at the US, I'm looking at the UK. So this is pure data that we have in our ecosystem. Now moving forward, what do investors like to back? And I know you're going to have Reese and Will and so many others that are going to detail some of their appetite for investment. We're clearly in an ecosystem where investors for the last 12 months have focused on, I would say, 3 core areas. The first one is healthcare and life sciences, and that has attracted a lot of investment. The second one is B2C. UK has always done particularly well on consumer and very well positioned brands, and we're still continuing to see a meaningful part of the investment and the capital in the ecosystem going to such companies. But the biggest share of the pie is clearly systems that address the enterprise phase, so software solutions, and they can be by vertical. If we look at the communication space, fintech, mobile, SaaS, AI, machine learning, they keep us on our toes, and they're clear trends that we have not changed in our ecosystem. So if you're addressing these markets, the investors have the right appetite, and you're going to find quite a number of VCs and investors that have that strategy moving forward. Life sciences and healthcare, I have highlighted, they are on the growth, and they're making quite an impact this year. The next stage in the presentation, it's very important because it will give you a sense of the benchmarks. Some of the questions that you will have right now is, what happens in the ecosystem? Are we really taking a huge beating at seed round? Are investors not investing? Should I postpone the funding round to next year? There that I have every day from clients and companies I work with, companies I mentor. I'm going to start with the European ecosystem because I think it's very important for you to just understand the broader picture. Companies have indeed more ambitious growth targets, but deals are still happening. The first time deals in Europe is 832. Yes, we're a little bit behind last year where we should have been in August, but deals are still happening. And the quantum for this particular space, it's on the rise. The average investment is going up, and I'm going to show you how this manifests in more detail in just a few slides. There are 2 themes that are very important to note. The first one is that resilience is at the core of everything that you have to do. And I know my colleagues in the ecosystem in the next sessions will highlight how they're viewing the market. But resilience is something that is built in, and you have to appreciate what that means for your commercial strategy, for your hiring plan, for your financial planning moving forward. So you have to be able to look at the next 18 to 24 months and have an answer, have a solution. That means you're probably going to raise a few larger rounds at larger valuations, which is not what you're being told in the ecosystem right now. And you're probably going to look at a larger spectrum of non-traditional investors investors in your round. So you're going to have slightly more diverse funding rounds this year than you would have had in 2019. Venture capital is definitely looking at healthcare, and this is just to give you a sense of how far we've gone this first half a year. Over 5.2 billion being invested in healthcare in Europe. In terms of deals, in terms of life stages, everything is on the rise, and every VC is repositioning themselves to address this particular market. So if you are one of the companies that is repositioning yourself and your product, I think that this is something that you should be very, very mindful moving forward. I can see some questions. Bear with me a second. Are you able, Julia, are you able to see the questions? For some reason I'm not able to click on it. Okay, here we go.
I am able, but like Flavia,
Tell me.
it's entirely up to you. You can move forward with the presentation and we can go through them at the end, or you can take some of them now.
I think let's just go through the content. I will address every single one of them so that we're having the sort of continuation of the knowledge.
Perfection.
Great, fabulous, good. Okay, now coming back to the UK. Seed has definitely taken a little bit of a step backwards. Q1 has been substantially below 2019. Q2, we were in lockdown, and many VCs, especially the ones at early stage, and across the board, have been focusing on their portfolio companies, trying to find mitigations, trying to close follow-on rounds to just pad their companies with a lot of capital and ensure that they're resilient. Early stage is clearly a very, very tricky period in the company's journey. However, we're not completely off the chart. We're not jumping off a cliff. Deals are still happening. The level of funding is still where it's supposed to be, and actually on the rise per company. So we're still in a very position, and the gap between last year and where we think we're going to be this year is closing. Every single month I've seen this slide getting closer and closer and closer and closer, and my projection is that we're not going to be more than 20% behind last year. So deals are happening. Yes, the pressure to have more traction, to be more resilient as a company, and to prove that you can grow even in a recession scenario are very important elements. Even with those things considered, investors are backing companies. Series A is doing a little bit better. So if you're heading towards Series A, you're thinking, should I go this year? Should I go next year? I don't think that Series A is as affected as seed rounds. We are seeing a very good appetite. We're seeing increasing the number of the capital and the number of rounds. And again, the gap between last year, which is was a phenomenal year in terms of investment, and 2020 is slowly closing as well. And I think we're going to have this discussion in about November, and we're going to see that shrinking quite considerably. So companies that have an amazing growth plan, they have been able to achieve that 1 or 2 million revenue mark. They're seeing themselves being able to grow moving forward and positioning the ecosystem, servicing the needs of their clients and users. I feel those companies are in good company, where we have a lot of capital in our ecosystem. In terms of deal size, this is where I feel the media is not necessarily presenting this information in the right way. We're told that funding rounds are depressed. We're told that we're not having we're not raising a lot of capital on average, and actually that's not the case. If you're going to the market today or this year, you are gonna have to present a plan for 18-24 month runway. You're gonna naturally raise a lot more, and this is exactly what's happening at seed Series A and Series B. You can see this continuous growth. Last year, when I was presenting this data and I was working with my companies, Series A was oscillating around $1 million. Today, in the middle of all the things that are happening, the average, the median seed round is 1.4 million, which tells me that investors are willing to put more than 40% more in a company, with the whole purpose is to create resilience and to have that contingency. So if you're going into the market right now, you're clearly going to be fundraising a lot more than you would have last year, and for very, very good reasons. You're able to capitalize on the changes at a macro level. Check sizes at seed round. This is a slide that I potentially use every single conversations with my companies. Every single time there's a question, should I raise less? Should I raise more? Where should I be? I need X amount of capital for this round to achieve the next milestone that is important for me as a founder or founding team. I would say that look at the data. Companies on Medium are raising 1.4 million. The top 25 percentile are raising over 2.4 million. So there are clearly a number of rounds that are substantially above that benchmark. And the bottom 25 percentile, so these are the smaller rounds with angels and family and friends, are raising around kind of 500,000 mark. And this gives you a sense of our ecosystem, where you position yourself, and why would you justify being at any of those points. For Series A, the shift is of course upwards as well. So we see on average and the medium increasing. We see even the bottom 25% are raising substantially more compared to last year. So it's clear to me that now is a time to double down, and investors are very aware of those companies that have an ability to go and gather more market share, increase their proposition, and become more resilient. So if you're in that bracket, definitely consider what is happening in our ecosystem and use your judgment, consult with the investors earlier in the journey just to understand their view. I know that my colleague Finn is going to go into valuation. So I'm not going to tell you how to value companies. This is a field that it's very, very exciting, and you're going to have so much fun with it. I'm here to tell you what happens with the valuation. So we're clearly raising a lot more capital across the board, across all the stages of funding. So are we really beating down companies and we're asking them to come at very discounted valuations? This is one of the questions that is on the lips of every founder I've seen and met in the last few months. The answer is no. The answer is definitely no. We're seeing now in this analysis over 300 companies that have successfully gone through that journey. And it's clear to me that they have not been pushed down. Actually, the valuation across the board, from the bottom 25 percentile to the top 25 percentile and down in the middle, has gone up. So it's clear to me that if you're looking at the data and if you're looking at the appetite of investors, that has not changed, and they're very mindful that you're raising more. So they're very, I think we're in an ecosystem where we're responding in the right way to the needs of the companies, and we're trying to adjust their strategy correctly. For Series A, of course, you would have expected larger rounds, larger valuations, the same across the board. So if you if you are preparing for Series A and you have all those ingredients, sorted out, it's clear that you're not gonna suffer in terms of valuation. This is increasing from the bottom percentile to all the way to the top and down the middle. Investors are showing that they have the right approach. They're thinking about companies in the correct way, and they're working with them through this process. And I'm coming to this slide, which I think is very, very important. So we've gone through the ecosystem, it's dynamic, what is really the key takeaway. And now I'm coming to how much companies are being diluted at each stage. And this is one of the things that has not changed. If indeed something dramatic would have happened, I would have seen it here. And I can tell you that this slide has been very much the same for now a year and a half. And it's being recalibrated almost on a monthly basis. So I'd seen around the expectation for founders that raise is to give up around 22%. At Series A is a little bit higher, so 28%. And beyond is something that has been quite constant over the years. If you're going into the market right now, I feel we're a little bit decorrelated from what happens in the mainstream economy, where we have a lot of capital in these newer funds that have entered our ecosystem. So from my perspective, I can't see a reason for you to go out there and think I'm not going to raise the amount of money, or I'm going to have to go very discounted on valuation. If you have all the right ingredients, you should be able to be very successful in your strategy. This section is exactly where all the amazing things are going to be discussed. So if you were looking at our ecosystem, and I know you're planning your investment round and you're thinking, what are non-traditional sources of capital? There are a few, and they're entering our ecosystem more and more. And I'm sure that moving forward, we're going to see corporate VCs, we're going to see angel investors and family offices playing a more and more important role in funding companies across early stage. And I think it's very important for you to just take a second to think about is your strategy sufficiently developed to include all of these sources of capital. I know everybody has angels and VCs, but have you considered the others? Have you considered maybe private equity? Have you considered family offices? Are they on your pathway? Is this something that you're working towards? If you're looking at the next stage, and looking with our clients and our company, every single one of them is telling us that they have the same kind of combination of capital providers. Venture capital funds are important. They're not that I'm going to discuss in a second. Organic growth is of course also very important. Looking at your clients to generate the capital for your growth, but this is a substantially reduced part of the strategies of founders. Corporates are again very important. Family and friends, family offices, angel groups, they all have a role to play. And I think you have to look at a mosaic. You have to look in its totality, especially if you're sitting at seed and pre-Series A. Why do companies fundraise? I feel that if you understand what you're fundraising, you're able to understand the combination of sources of capital that are required for you to be successful. If you mix and match them, you might not necessarily get the result that you want. And I know firsthand a number of founders in my portfolios that have taken a market-wide approach, spent maybe 6-9 months meeting with hundreds of investors from all of these areas, and being very disappointed that the 10 VCs or the aligned investors, they haven't actually been able to meet because their approach was not very focused. And that can cost you dearly. It's very important to understand that if you are at seed round, you're raising for two things. You're raising for the technology and building the product. You're raising to validate the market or to understand it and to get the right talent within your company. And the next stage as you're approaching Series A is to have very good optimization exercises and find your product market fit. And this is a very difficult one. It means that you have to be confident that if you put X amount in your marketing and your sales function, you're going to get X amount of lifetime value, and you're going to understand the contribution of each client. That is what it really means. You have a predictable, to some extent, a predictable model. You understand the dynamic of the market you and the client you're servicing. And that doesn't mean you're done with the product. I think that to some extent you're never going to be done with the product. You're always going to have to improve and deliver the expectation, ever-changing expectations of clients and users. But this is the point where you prove that early traction. Companies that go from 0 to $500,000, $1 million, it's clear that they're able to prove that traction. That is what you need to do pre-Series A. And Series A is that inflection point where you're able to take everything that you've done before and to have a company where you need a lot of capital to be able to execute your plan, to be able to take more market share. Let's say if you focus just on the UK, be able to maybe go to the US and start testing there as well, attract some of the best talents in the business, and be able to develop the functions of the companies that enable you to grow. So maybe more marketing, maybe more sales, potentially less on the product. As you're making this transition, the focus is definitely going to be on expansion and market size and competing head on with your competition and differentiating your proposition. The talent element doesn't go away, but if you're able to drive towards an exit, it's clear that execution is the theme of your journey post Series A. And as you're getting to a point where you're 100% profitable, you're able to continue to grow, but yet not at the rate that you will between seed and I would say Series B and C, you're going to start to position the company with your investors towards the exit. What do you fund? Where's the capital coming from at each stage? Universities, government bodies play an important role. We've seen how Innovate UK and many other universities have stepped in our ecosystem, supporting early stage innovation, that R&D stage where you're still working out your product. We've seen accelerators and incubators, of course, playing an important role, family and friends and angel investors as well. So these are the these are the types of capital that you absolutely have to bring together. Crowdfunding has a particular purpose, and I think it aligns very well those companies that need market validation and they need a user/investor. They need a platform. It works very well in some cases. We've seen great success stories like Moneybox, Monzo, and a few others. It might not necessarily work for very deep tech. It doesn't work for life sciences. I think that is where you're going to find very specialized angels or syndicates rather than crowdfunding. As you're moving into early traction, this is where venture capital funds, the early stage ones, start to address, and those are going to be the discussions that you're going to have. But venture capital is very broad. I would say that there may be 3 different buckets of VCs. The first ones are addressing this early journey from, let's say, pre-Series A or seed all the way kind of to Series A or B. And they're particularly positioned to give you the guidance, sit on your board, be very active with you. Then you have the middle section where they're looking at growth. So they're looking at making you go from that 1 or 2 million to maybe the 10, 20 million mark. And they're able to drive you through Series B and Series C. And then the final part, the investors that sit at late stage, they're particularly positioned to take you from that growth stage to the exit, whether that exit is an IPO or whether that exit is towards another trade sale, or whether that exit is selling to a private equity firm. There are a number of exits. And I think that it's very important for you to understand the combinations and the fact that there's a broad spectrum. So you being able to double down and understand what they do is very, very important for your success. Seed to Series A journey really involves a combination of things. It involves maybe 3 rounds before you even think of Series A. I've looked at about 120 companies over about 3 years, and it tells me that everybody has this predictable pathway, a pre-seed, a seed, and a bridging round. It's very difficult to get with seed to Series A. They're really just outliers that are able to do that. The average company has a requirement of at least £3 million of capital to get to that 1 or 2 million of revenue. And this is something that you have to be mindful when you're looking at your projections, when you're looking at your commercial strategy. The things that are going to really impact your success some are related to the way you think about your business and the way you position yourself and the strategies that you employ. And the others are around how you monetize. Being able to validate early is a key. And I think if you don't do that at the early stages, even at pre-seed, when you don't have a product, it's going to have an impact. It is like repercussions later on. Investors expect to see a level of revenue, expect to see a de-risked proposition nowadays. And this I don't think is going to change, which means that you have to think about validation and monetization a little bit earlier to be able to bring that evidence to your investor. Failing to research and failing to align yourself and understand the strategy of investors, again, can be quite tricky as well. Allocating your precious time and resources to the investors that are not aligned to the stage of development can be particularly tricky. And I wouldn't want any of you to lose opportunities to fund your companies because of you allocated your time elsewhere. I'm going to whiz through a little bit of the investment process. So VCs, as we all know, are amazing people. They manage other people's and other institutional capital, and they look at investment companies that have a huge potential for growth. So they're looking at outliers in the big scheme of things. If you're thinking about an IRR of an investment process, an investment project, you really have to look at something annualized around 50%. So the IRR annualized for a VC company is somewhere around 50%. So it just gives you the magnitude of growth that you have to deliver. These professionals have a high risk tolerance for their portfolio, and they diversify very well. But they also expect a very low percentage of success. However, they expect very high levels of returns on their initial investment. So the key from this section is that they're very active. They're going to be involved in key decisions. They're going to expect specific rights to participate in in investments, to participate in decisions. They might have control rights, such as being able to have a right to first refusal, have access to dividends if you're going to ever issue one. They're sitting on your boards or they're observers. This can have a huge impact in the way you manage the growth of the company and the strategy moving forward. And you have to be mindful that VCs will always be a unique type of investor in the big scheme of things. And they will have specific rights which you have to be aware of. And I know my colleague Reese will go into the term sheet and he will probably touch on some of these things like the liquidity preference, seniority, anti-dilution, and many other things, which you should definitely consider as you're planning ahead. What is an investment process? An investment process is the interactions that you have with the investor from the initial meeting all the way to a decision and you receiving the capital from the fund. And it's not as simple as we make it to be in our ecosystem. The first stage involves a number of interactions with the VC and various different people in the VC. Looking at the company, looking at your business plan, looking at your go-to-market strategy, at your financial projections, even having customer calls or client calls that with clients that you may be aware of or you might not be aware of. And being able to evaluate your technology, this is where potentially you'll have a review or an audit. You might have an expert opinion if you're working in a VC. And you're thinking about how best to structure this particular deal to make it advantageous both to you as a VC and also as a company. So if I was in the shoes of a founder today, I would ensure that at every single stage I'm able to articulate and I'm able to interact with the investors and go through all of these interactions gracefully. Because if you do, then the next stage is down to the VC. There are a lot of things that happen behind closed doors. There's a lot of hard work that goes into preparing a deal. First of all, there are searches and research on the founders, on the market, their discussions with market experts. There actually sometimes VCs go and do their own market research and get their own primary data just to validate independently. And they do their own financial appraisals as well. At the end of which everything comes together in an investment committee paper. And then the decision makers in the fund will be able to have that interaction and evaluate the proposition in its totality and align it with the fund strategy. And if these things aligned very well, then they're able to offer a term sheet. And if you're accepting it, then the next stage is obviously formalities. So if you wanted the bare minimum of the things that you have to have ready as you're going out there into the ecosystem, whether you're speaking with angels, which are in some cases highly experienced investment professionals that like to invest with their own capital, VCs or corporates, there are a list of things that you absolutely must have, and you must have at the final detail. I would say market analysis, the product roadmap, the strategy for sales and marketing, and your financial projections are the very, very, very basic things that you absolutely must have from day one. Now, if I'm looking at venture debt and the way you capitalize a company beyond Series A, there are particular tools that you can use to provide a little bit of leverage in the company. There are many, many, many different products out there, and it's very, very good for you to be aware that usually they start somewhere around Series A, B, and C. They offer you an ability to accelerate the growth of the company very well. They extend your runways potentially between 3 to 9 months. They enable the company and the founding team to avoid dilution. So you're able to use a fund or a bank's capital to achieve a lot more, to be able to drive towards the next round a lot quicker. And we've seen in the market how between Series A and B usually is like 18 months. It didn't used to be this, but there are a number of ways in which you can now capitalize the company to achieve quite a lot of growth in a shorter period of time. And of course, to manage your working capital. Depending on the model, this may be more or less important, but either way, you have to be aware of all of these elements as you're looking ahead. And here's a very, very simple case study. There are a number of solutions out there, and I know many of you have been in the industry, you will know it, but just in case you haven't, you will see that at the venture stage, so this is maybe Series A and B, you might have venture debt alongside your Series A VC round. Later on, you might think about an accounts receivable facility. You're doing very well, especially as is the example, it's a SaaS company. Accounts receivable facilities are quite common, especially for both companies. You're able to release the capital ahead of time and be able to reinvest it in growth. Later on, you might want to have a larger venture debt facility with your Series C, which usually is somewhere around maybe 80 million or more in some cases. And as you're driving towards that pre-IPO, there may be other tools like mezzanine finance and acquisition finance, which you might want to do. So as you're driving beyond Series B onwards, there are a number of various different financing products which are specifically designed for technology companies that might not necessarily be profitable for quite a while, as they're going out there and they're growing at a rate which is way in excess of a conventional company. And the final part, which I know many of you are awaiting. If you have any questions, drop them in the section. These are the top investors that have backed companies and the number of deals. There are many of the people that are going to be here today. My colleagues are, clearly they do a number of deals as well in our ecosystem, but there's some that do potentially a bit more. So Mercia, Scottish Enterprise, Techstars, Local Globe, Maven, Power Equity, there are only a few that have done quite an impressive number of deals, and you might want to consider them in your journey. The most active VCs at Series A are some of the people in this particular slide. You will see Will later today, and I know that he's going to tell you their strategy for the UK. And the most important bit is that even US VCs are looking at the UK and they're making investments. So these are a selection of funds that have been very active in our market, whether we know it or not. And I feel you should definitely have them on your radar as you're planning ahead, because these guys are clearly very, very well positioned in our ecosystem. And this brings us to the Q&A section. So bear with me a second. I'm going to try to get the questions out.
Thanks a lot for that, Flavia.
Yes.
Actually, you went through it a lot faster than what I expected. You don't need to worry about the chat window, because I can happily.
Oh, fabulous! Go for it. Yeah.
So the first, and again for the attendees, I might call you in on some of those questions from time to time, but I would suggest you to sort of like kind of keep popping them in there as we go through them, and as Flavia keeps answering some of those. So one of the first questions, which is when obviously you were talking about the fact that a lot of the early stage investors at the moment do actually expect the companies to generate revenue very early on, right? So one of the questions is actually like, then if that's the case, and if you need to generate revenue early on, then what's the sort of kind of size for a seed deal that you could or you should go for in that case?
So we've seen from the data, the expectation for revenue is somewhere around £500,000 for a seed round, and the average seed round is somewhere between 1.2, 1.5. That is the average, with the top deals being in excess of 2 million. So that potentially gives you a sense of, if you're not at that level, potentially you're at a pre-seed round. And the way in which companies prove traction while they're still not reaching those metrics is by going out there and validating. If you're able to prove that, look, I haven't finished building the product, but I have 1,000 companies or 1,000 users that have registered their interest, or I'm in touch with these 5 corporates and I have pilots lined up. You try to de-risk the proposition. Going out there and saying, oh, I'm still working on the product, I don't have traction, or I have very little, might not necessarily work this year. I think you have to look at how can you de-risk the commercial element? What can you do at the earliest stages to engage with the client, the customer, the user, and try to validate, try to gather as much evidence about the validation part. That is what's going to distinguish you from everybody else. The more you're able to do that, the better.
Thank you for that. And actually, the next one is, again, still sort of like kind of tapping a bit into that. So just because you mentioned revenue, and one of the companies is like, since January, when they had 500 monthly recurring revenue, they went up to 30K, right? And that question is like, are we now ready for a seed round?
Obviously, it really matters what you do. Really does. Every single vertical has its different peculiarities, I would say. If you're selling to corporates, then potentially you absolutely have to prove that you can reach that benchmark, and that you're very efficient in the way you sell, and how you manage longer sales cycles. If you're addressing the SME market, then it's very important to say, absolutely, I've had this growth so far. This is the cost of acquiring. This is how I sell. This is how much I spend getting a new into the company. And these are the resources that I have. And the proposition to the investor is then, if I had X amount of pounds, then I would be able to get X amount of clients, and therefore be able to grow at the level that allows me to do my Series A. So absolutely, if you've seen a lot of growth during this period, you think that there is a shift in the market that you're addressing or the type of client that you're having, there is no problem you being able to articulate that commercial strategy and what the investment can do for your company. But definitely being mindful that you have to drive towards a point where you can do the next round.
Thank you. Well, Max, I hope that answers your question. Now we're moving on to the question from Phil, which is, again, going back to, I guess, one of the first points that you made around resilience. So he's like, if runway and resilience are the sort of like kind of key factors when you're fundraising, does that mean that investors are being more cautious about risk in some of the new areas? Phil, would you want to go a bit more into like, what do you mean by new areas? Like, do you have any examples there?
I mean, new kind of market areas, I guess, which are less, we've got by definition higher risk, because you're looking to make more of a breakthrough. You're looking to more create a market rather than just exploit something that's there. It just sounded like everything that the speaker was saying, oh, I want now a longer runway to see where this is going. And
okay, so here's where I'm coming from. In the previous recession, venture capital and private equity were uncorrelated for about 1.5 years, 2 years, which meant that for about 1.5 years, 2 years, they still had a lot of capital to deploy. This is kind of, let's call it dry powder, that it's just sitting with some of the funds. Why is it the 18 months to 24 months runway that is required? A recession usually lasts that long. And if we're going to come out of the lockdown, not only here but all around the world in a specific scenario, the investor wants to be sure that you can navigate through that period and continue to grow and continue to do business. So if they're investing today, they have to just ensure that in that scenario, which it's very probable, you as a founder, or as a founding team, you will be able to navigate. I don't think this is about a specific type of technologies, because we see investment in very deep tech that still needs a year or so of research. It's just they want to make sure that as you're coming for the next round in the market, that you're not coming in the middle of a recession. And this is something that you have to be very mindful. If you are coming to fundraise in a recession, the odds may be stacked against you, even if you're a really good company. And the investor wants to make sure that you have enough capital just to whiz through.
Okay, thank you. That's really useful.
Wonderful. Thank you, Phil.
The next question, I guess, taps a bit more into the GP sort of like kind of LP behaviors. So Muj is saying, and I don't know if I said your name right. If I haven't, please feel free to correct me. So he's saying that it looks that across the board, the risk appetite has gone down. And basically like seed is now looking more like Series A is looking more like Series B, and so on, right? And he's asking like how have the VCLPs attitudes changed, and have they started to allocate more to public equities with all the euphoria we see?
That is a tough question, man. Really tough question. Okay, so obviously every single one of us probably looks at economic data. We're seeing that equity markets are swinging up and down. As we went into the lockdown, we've lost 20-30% of our pension pot. So it's clear that public equity markets are performing to some extent. You know, they're highly volatile. As it happens, I'm a trustee of a charity. We have a capital markets fund that is invested by one of the largest asset managers. And I can tell you right now, irrespective of how much money you have in such a diversified fund, you're probably not going to have more than 3% income over the life, annualized over the life of the fund, which means that to some extent, there are different strategies. The capital market is very liquid, but very low yields on your capital. So as an LP, obviously, if you have 50 billion or 100 billion under management, you probably are going to be exposed to that. Venture capital is looking at a very longer time frame. So this is almost an illiquid investment where you lock the money in for at least about 10 years, in some cases a lot more. And the expected return annualized for this industry is somewhere around 7-8%. So you're expecting substantial more return because you're willing to take risk. And the risk is obviously out of all the investments that are being made, only less than 10% are very successful and return the fund. So from an LP's perspective, VC still remains a very important part of their strategy long term. And it's a type of investment or asset class that has received more and more attention over the last few years. I don't think that will slow down given how capital markets perform and the level of return.
Thank you for that one. And now we're moving, I guess, into a US or like kind of territory. Another question from Shama. She's mentioned that US VCs actually require companies to set up shop in the US, which brings complications around IP and tax and so on. I guess, what's your view on that? And that's part of the first sort of like kind of question. But then have you, like, based on your experience and all the companies you've worked with, I guess, what are some sort of like the good examples of companies that went and did that as well?
Oh my, the transition to the US from the UK, it's a tricky one. I obviously every single investor will have a different view. So definitely this is a personal opinion. There are two windows where you can make the transition well. The first one, I think, is kind of Series A, where you've proven the market a little bit here. You consider UK the petri dish for the US. You're experimenting, you're optimizing, you have the product ready, and then you make the transition. You get your Series A. Maybe a US investor is leading on this, so the transition is naturally, the flip of the structure is natural. But the company will become more of a US company rather than the UK. You will have a satellite in the UK. Yes, there are tax implications, there are legal implications, and I think that naturally consult a tax expert, a lawyer, as you're considering doing the flip to the US. The second window, it's, I would say, after Series B, when the company has raised maybe 20 to 50 million rounds, they're very aggressive on the growth. And therefore, that is when you have a satellite in the US, you're gaining as much market as you possibly can. And the reason why you do it is because you're preparing and aligning the stars for your acquisition. So you're proving that you've scaled very well, you're a very robust company here, you're able to raise a lot of capital, very strong position, very aggressive on your commercial strategy. And then the only reason why you're going to the US is to find your exit. You're going to bother someone so much that they're going to just give you $500 million to disappear.
That makes complete sense. Shama, I don't know if you're still on the line. I hope that answers your question. If not, feel free to sort of like kind of
yeah, that's really nice to hear that, actually. Just because there's been a number of seed investors or pre-seed investors who are interested in us, and from your answer, I just hear that would be too early for a UK company to go over.
I think if you go very early, then you're gonna lose the presence here unless there are multiple founders managing this, and whenever you're gonna fundraise, if the headquarters is in the US, you're potentially, there are quite a number of funds in the UK which might not be able to invest in you because you disqualify yourself purely based on the corporate structure.
The next one is actually from Alexander, tapping into the relationship with a venture capital firm versus the relationship with an investment bank. I guess, how do you approach that? What are the differences? And what should founders look at when they build those relationships?
I'm not sure that I got a question with the investment bank.
Alexander? You still on?
Yeah, sure. Yeah,
Hi, Alexander.
Good morning.
Morning.
I just want to understand a bit more about how a relationship might be different between, say, a startup and a VC versus a startup and an investment bank, and what to look out for in terms of the potential for a good relationship or kind of red flags, perhaps.
Well, obviously, this is, look, the relationship with the venture capital as you're approaching your seed or your Series A, you have to think about it this way. The investor is not going to go away until one of the few scenarios where the company closes down, so it's been unsuccessful. You make a trade sale, private equity buys it off, you IPO. So the investor that backs you at any stage, all of those investors, all of those VCs, there are relationships that you have to be 100% sure that they're going to be long-term, and you're not going to be able to exit them unless specific events happen. So I would go and say that it's like falling in love. You absolutely have to take the time and have so many interactions to make sure that you not only need their capital, but you want to have their expertise. You want them to come to your meeting. You want to spend time with them. Because if you don't, and you don't see that value, then the relationship is not necessarily going to start in the right way. So with the VC, think of falling in love. It's the birth of a great relationship that has to sustain, and you have to work over years to manage it very well. The relationship with an investment bank, I don't know why you would have a relationship with an investment bank at this stage. Clearly, you know, they're not addressing this early stage market. They might be investing in funds. They might be using technology for their own transformation. I'm not sure why you would use the investment bank angle. Obviously, there are very different types of financial institutions. It's really important to you to understand what you want from the relationship. Is it like with Silicon Valley Bank? I work with my clients. I ensure that they're connected. I give them insight. I share with them the experience. I become a sounding board and a friend. Hopefully, this is what you would want from your banker as well. But investment bank is really kind of targeting more of a pre-IPO, IPO market. So maybe that relationship has to manifest itself as you're progressing beyond Series C and you're able to drive the company towards the exit. And clearly they will be able to advise you on how you can make that transition.
Great, thank you. Brilliant.
And actually the last one, although I do have a couple of questions on my side as well. So I'm not sure if you have a lot of sort of like kind of insights at the moment into the VR sector. I know you're preparing a session around that for us in the next few weeks. But yeah, the question is around like, how do you see the investments in the VR sort of like kind of ecosystem evolving?
So, this is a tough one. I'm working on a bit of research on VR and its applications. I think that the level of attention that is received recently has gone up. So in terms of number of deals globally, in terms of the capital invested, the more we move into the space where VR has applications beyond the entertainment gaming, and now I'm looking, my bit of research that I'm working on is looking at the healthcare application, therapeutics, and very different mental health applications as well. I feel that we're gonna see these becoming very, very popular, but it's still very early stage. Companies that I've seen and I interact with in my day job, they're very, very early stage. They're still testing. They're in R&D. So I think it's emerging. It's at the frontier, but it might take a few, maybe couple of years for us to see this as a mainstream.
I mean, I wanted to say that as well, because one of the companies that went through our first augmented program actually just closed an investment round with Kindred and Point 9, but it still took them, I don't know, 3 to 4 years to get to that point. So it's unfortunately, I guess, compared to a lot of the other sectors, it does take still a bit longer to again to get to a commercial point. Yes. Richard, do you want to sort of like kind of, just because it's more of a conversation rather than a straight ahead sort of like kind of question, do you want to ask your question around the alternatives to Series A, B, and so on?
Yeah, sure. Hi, Flavia. How are you doing?
Hi, Richard.
Long time no see.
Yes.
So basically, something that I see a lot of is that as an alternative to going through the traditional VC route, there are actually opportunities to sell, to exit early. There tends to be 2 points where you can do this. One is where you're a pioneer and you've got considerable expertise and experience in the team, so the team's of value.
Yes.
And the problem that you're solving is difficult. So the technology that you've created provides an accelerated route to market.
Acqui-hires are very common, and large technology companies do it all the time.
So if you have that, then an alternative to ABC is to sell out to a strategic corporation or to private equity. I know you have private equity positioned at the top end, which is always where I thought they used to sit, but I see them doing an awful lot of bolt-ons. I think bolt-ons outstrip platform deals by over 5 to 1 last year, and that's grown. The number of private equity portfolio companies acquiring early stage company has accelerated this year, especially. And I was surprised, and it's great to see that the VC market is there, and I can see the reduction in risk. and the kind of the lens focusing more capital onto specific targets. But that means that there's and I was surprised to see the number of deals going up, because I would have seen, from what I've seen, actually some VC funds haven't raised their next round. So therefore capital was being redeployed in existing funds to existing portfolios. So the merchant or investment banking route was actually a very interesting alternative. Is this something that you've seen or got experience of?
Look, Richard, this is a very good point. We all have seen the trend of private equity, which, just to give you, give everybody a sense of the magnitude, however much capital it is in all the VCs around the world, private equity has like 10 times more. And naturally, for private equity, they have been very well positioned plugging themselves into larger institutions. So being able to raise funds into billions, tens of billions, has been a lot easier for private equity than it will ever be for venture capital. This is again a personal opinion, and what I'm observing is that they're trying to close the gap. VCs have monopolized, have been able to drive the valuations considerably up. So when naturally private equities would come in, the valuation would have already been like the sort of $500 million, and that would have not worked for their funds. So we're seeing a lot of them stepping down and being able to devise different strategies. But I think it matters it really matters how you plan the journey for yourself as a founder or founding team. If you want to build something for acqui-hire, and I've had about 3 in my previous portfolio to some of the top companies that we all know in our ecosystem, you have to do that by design. It can't be incidental. And this is one of the, this is the challenge. If you don't plan for that acqui-hire, if you don't build a relationship with the corporate, or one of the partners doesn't come from that corporate, it's going to be very difficult to do the acqui-hire route, just simply without investing a lot of time and having the right expertise and building the right product for that company.
So just to jump in on that point, if I may.
Yes.
I would disagree respectfully. I mean, I think it's great if you've planned that route, but I think if that mix that I was talking about in terms of team expertise and experience, and I differentiate expertise and experience, plus the problem that you're solving is hard and high value, then I don't think you need that relationship yourself. I think that is where an investment bank or an advisor comes in, because they will have that relationship. They can position you as a company.
And at what stage would you want to make the transition? Sorry. At what stage do you see the transition? So have you built the product? Have you gone for like Series A?
You've got to have product. You have to have product. You can't do this without product. But you do not need to have done Series A. So if you are, I mean, I guess the best example of a pre-scale company selling at an absolutely astronomical valuation is Android, right? It's the classic. They had south of $1 million in revenues when they sold to Google for 50 million. Now, did Google overpay? Probably not, when you consider what they've done with it since. Now, that's the top end of the spectrum, but there are a lot of smaller companies where you can sell for, let's say, anywhere between 5 and 30 million, depending on the stage you're at in terms of traction. The earlier you are, instead of getting a valuation of 5 million for your Series A.
But Richard, then the question is, do you really want to build a company, or do you just want to exit? Because you're clearly not going to have control. You're probably going to be tied into a contract for, I don't know, a year or two to transition the people in the right teams. But that in my view absolutely is a valid strategy, and I think it works. Some entrepreneurs want that journey. I just think that, again, it should be by design. This is what you're driving to, and
I agree, but again, one of the things that I see, and also having been running Insignia for 10 years now, your plans on the 3 to 5 year horizon don't always come to fruition. And I always, as an older entrepreneur, my risk appetite was never great in the first place. I don't believe entrepreneurs take risks. We just know how to mitigate things that other people can't mitigate. So my risk appetite's decreased. So I'm always looking to de-risk. And I think if you do the wrong deal, you can lose control. But I think if you do the right deal, you can retain enough elements of control that you're now sheltering under a bigger umbrella with a stronger balance sheet behind you going into a recession.
One quick intervention here. So if you're selling the company, that is no longer your company. So every single time I have 3 exits exactly like that to companies that you and I will both know, but I can't say who they are. Every single time you lose control. And in one case, which happened last year, the founder was actually, the team was split immediately. So it's not like you could say that, you know, this corporate is funding you to build your business, or this private equity is giving you capital, and all of a sudden you can, no, absolutely not. The control changes. So it's no longer your company.
That very much depends on the acquirer, though, because there are some, for example, where their structure is loose, it's federated, they'll take 51% so that they maintain control, but actually they don't interfere in your day-to-day running of the business. So I agree with you, you do lose control because they're going to take a stake. But that's about post-integration planning, and that's about being able to negotiate the deal. So if you're running these processes in parallel, you have the data points and the ability to make the choice. And that's what I like about it, is because then you can bake it in by design, and you can go, well, actually, no, I don't want to do this. I don't like that deal. I'm going to go Series A. Or you can say to the Series A guys, I'm sorry, I've got a great offer over here. And I think it just adds competitive tension. But for me, as a founder, it adds data points. You know, it's something that it was prompted by this, you know, this previous question that was raised.
No, look, I'm really glad that you've brought this up. It's clear that those are really good key points for me to take away and investigate a little bit more. I know that we have a team that works with private equity firms, and it would be very interesting if I could find the, you know, quantify what you're noticing with data. I think it would be very interesting to just see how many such deals happen in our market. And maybe next time.
I've got some data on that I can probably share. So you know, let me know if you want to talk offline.
Yeah, I am gonna not interrupt you here, but like I'd love to make sure that we don't get stuck too much on one question, just because obviously there's still a couple of the questions popping up, and I want to make sure that we go through all of them by the end of the session. But happy to put the two of you in touch afterwards. And yeah, if you don't mind, I'd love to move to the next one, just because again we're soon going to run out of time. So this one, but thank Richard. Thank you for actually building such an interesting conversation. So the next one taps a bit more into that diversity, and we've seen a lot of initiatives, both from, you know, a sort of kind of invest in diverse team, all the way to how do we get you know, more diverse investment teams, right? So have you seen sort of kind of any trends in female funded companies lately? Like has that increased? Like what's changed? I don't know if you've noticed anything, or if you have any data around that.
I from my perspective, I think over the last 3-4 years, we've had quite a lot of attention on diversity and inclusion, and you can see that we've made a bit of progress now. 1 in 4 people working in a venture capital fund is a female, which is a very good thing. Until very recently, it used to be less than 4%. We're getting into 2 digits, which is really good. And I think that on the investment side, things have improved as well. And we've seen from the largest funds in the US all the way to early stage funds here in London, whenever they're having competitions and evaluating companies, they always allocate a lot of space for women and diverse backgrounds, because it's not all about including women, but it's including everyone, irrespective of your background. And I think that this is something that is going to take a little while for us to get to a point where we're 100% happy with the way things are operating. We're just getting to a point where Diversity VC has introduced a standard. It's a milestone in our ecosystem. I expect that we're going to see VCs taking in consideration diversity and inclusion at the hiring point, evaluating companies, and ensuring that they have a way that women and founders from very different backgrounds accessing them. And I feel that I can see it happening. I can see many people that I work with in the ecosystem telling me that they have clinic days, one-to-ones, and their whole, they want to see a very diverse set of companies and founding teams. And if they don't see it, then they're probably going to have a question on it. It's something that until the last year and a half, I've never seen before. So I feel very optimistic that the future is, we're building it. We're in a process of building it, and we're going to see a lot more wonderful founders and founding teams coming out of this with good backing.
I mean, I've also seen, and I'm seeing those opportunities on the weekly Startup Digest as well. But like, I've seen lots of, from Playfair Capital and their female founders office hours to the Atomico Angels initially. Yeah. There's also the Appraisal that Wire started. Like, there are a lot, like from an investment point of view, there's a lot of support out there at the moment. And I believe that, things are slowly changing.
Exactly. A year ago, we didn't used to have all of these things. I'm impressed.
So I hope, Claudia, that answers your question. Again, if anyone has any burning questions, we have less than 5 minutes left to conclude the session. I will ask you one, which is more on the kind of early stage, investment side. So you've mentioned, all of this kind of the alternatives to, venture capital, like angel investment or family offices and so on. I guess what's your piece of advice of approaching those for the founders here today?
They're very important sources of capital. Just looking at the last decade, over £1 trillion have been invested in the innovation by individual investors. So we can't say that this is just a simple source of capital. Without angel investment, our ecosystem would not exist. VCs would not have companies to back. It should be part of your strategy. And there are many ways in which you can approach it. Many of them are very vocal about them being investors, angel investors in companies, showing up at a number of events, having discussions, putting things on their LinkedIn or angel list. I feel that, and even Crunchbase. So I feel that if you really wanted to find such individuals, you would have, even if you didn't have any network whatsoever in this space, there is a way in which you can search and you can build that connection with them. Every single angel investor that I see is proud to be backing companies, and they will always have 5 minutes, 15 minutes for a call. They're always interested in great new investment propositions, and they will give you time if you're spending and doing a bit of research and trying to connect with them. And I think during this period, we can do quite a lot of that groundwork, sitting at home or sitting in our offices. We can do that granular work. There are a lot of things that can be done with angels, and they play an important role in our ecosystem.
I completely agree with you on that one. I mean, it's again another thing that's changing in the ecosystem, which is like there are a lot more angel investors out there, and it's becoming a lot easier. Like, I'm not saying it's easy and full stop, but it's a lot easier now to build relationships with them, and it's a lot easier to actually find them. I guess the still the main point is like, how do you build that narrative around it, and how do you like get to open the door, if that makes sense.
If I can suggest a way, and I know every single one of you guys right now attending the conversation, you will have your own strategies for going out there and approaching other humans for investment. The technique that I found particularly useful is to connect, not necessarily just to sell them something straight away, but to just inquire whether, you know, they can give you a bit of feedback, whether they can have a coffee with you. Look at building relationships at a more humane level. Think about those interaction points. And then once they get comfortable and everybody, I think most people are willing to help one another during this period. We all realize it's very challenging. It might be even challenging for us being stuck inside for so many months. So I feel that if you wanted to build relationship both with your investors and your and angels, definitely look out, connect with them, have a virtual coffee, get to know them, get to know their background, get to know what they think about what you're thinking of doing, and then when you're absolutely convinced that this is the right type of investor you would want in your company, discuss the investment elements. I think that is how I would approach it if I was fundraising for my own company right now.
Thank you. Thank you. I think that's actually like a very strong finish to the session. Thanks a lot. I mean, very, very useful insights today. We will share the recording with both yourself and the founders afterwards. And everyone else, if you have any further questions for Flavia, let me know. I'll be more than happy to shoot them her way. Flavia, again, thanks a lot. It's been really, really great to have you run the session. For the founders, we will stay online. We'll take a very quick 4 minutes break, and then we're moving to the next session. Flavia?
Thank you very much.